Harry Dent here on June 19th with a special update. I think we're getting near the top of the first wave in this recovery from the 35 to 40% crash that signaled to me that this bubble was finally over. And I warned that in advance, and it happened, and now everybody's blaming it on the virus, and virus does obviously have a lot to do with it, but it's just the perfect trigger. We've had major viruses before, don't get anywhere near this reaction in the markets. The markets are massively overvalued. In fact, recent Bank of America survey of fund managers had 78% of fund managers saying outright stocks are overvalued. That is higher than ever before at the top in 2000 or any other time in the history of this survey going back. So that's a sign. You have Ray Dalio, most successful and largest hedge fund manager, saying, we're probably in for a lost decade for stocks. In other words, stocks aren't going to get any better than this for 10 years. And that also means they'll obviously go down a lot, as happened in the lost decade of Japan, that, by the way, turned into 3. But the best one, oh boy, do I love this, Jeremy Grantham comes out and says, this is the real McCoy of bubbles. And that's exactly what I would say. I just didn't think of that term. That he has predicted the 87, 2000 and 2007 bubbles in advance. And of course, like me, he was early warning about this one, because this one is so unusual and has been pushed by stimulus beyond even the most liberal economists could have possibly forecast what it would take to keep this dead economy going and keep pushing up financial asset prices. But again, he said, make no mistake about this. This is a bubble. And what he said, most important, it's never have we seen a bubble like this, nevertheless the magnitude, in a time of so much financial and political uncertainty. I mean, bubbles like this come when things are great. I mean, in 1999, early 2000, the tech bubble was going, internet was going, 4 or 5% growth, falling. I mean, everything was hunky-dory. 1929, hunky-dory. 87 even. 2007. This is happening when we're in a temporary depression, and the markets are assuming we have a perfect V-shaped recovery. Oh, that's nice. They're only doing that for one reason, we know. There's been so much stimulus put behind this. You know, another 3.45 trillion since the repo crisis now. A Fed money printing 1 trillion in fiscal stimulus turns to 4 trillion, actually 3 trillion that'll hit this year. And we got another 1 or 2 trillion. I mean, fiscal deficits off the charts. This is why the market's got to find a reason to go up. But we have to notice here, something has changed. I was tracking since the repo crisis and the Fed started stepping up rapid quantitative easing again. Stock markets were following it right up. I mean, 100% correlation. Now, no, after this crash, yeah, the recovery's strong, but it's not going up at that same correlation. Considered how massively more money's been printed. Gold, which I'll look at here. Gold is not reacting to unbelievable money printing like it did from 2009 into 2011 before inflation kept dropping no matter how much money they printed, and gold finally corrected. Gold is not reacting the same as they did. Gold should be at 2,000 plus. The dollar's down in gold. Would get a 5% kicker just from that and should be over 1,800 and hasn't. So that's what I'm looking at today. I think we're at a very critical point. I'm going to start with the first chart here, the NASDAQ 100. So that's just a little more concentrated than the NASDAQ, the top 100 stocks. It's been the lead dog in this whole bubble along with the NASDAQ. And it has made those new highs, which I did warn in the May newsletter. That this was very likely to happen because the NASDAQ never violated its uptrends on the bottom side like every other major index did. So that's happened. Look at this chart. This, I'm saying, is the final kind of channel to complete that first wave. And with the caveat here that since this rebound has been on so much hype and has been so strong compared to past rebounds, even though happening in a similar time frame, this could be it. This is one reason I've told particularly more conservative investors, you may want to get out half or even 100% now, because what if something goes wrong, particularly with this beautiful V-shaped recovery, or the markets start to really get that Trump could lose this election, and we have Democrats raise corporate taxes, which would knock the market down 20 to 30% right there, as well as higher marginal rates on wealthy people, which are also the other big part of the bubble. So that's something to take in consideration. But this looks like we're coming into the final phase. I would actually say, looking at this chart, the NASDAQ 100 hit 10,156 a few days ago on the 16th. It could retest that, make a slight new high, or it doesn't even have to go there. That could have been the top. This is the bounce up before we go down. But I think this is going to be a substantial correction. 15% or more for the broader markets like the S&P, 20% potentially or more for the NASDAQ here, since it's been so bubbly. So we'll see. It doesn't have to be that much, but it should be a substantial correction after a rise this big. So this is the big turn. I still would say the most likely scenario, we go down into July, we come back up at least into mid to late August to complete this second wave, or that wave lasts as late as close to the election into October. I do not see it lasting past that. And that could take us to maybe 10,004, 500 on the NASDAQ 100 and the NASDAQ, things like that. And we could retest the S&P 500 highs. I even have one scenario where we could go a little higher. I'm not going to get into that today, but that would be the ideal scenario for investors to get out of this really nicely. Yes, you missed the first crash, and I expected everybody not to listen to me on that, because I said it was going to happen in early to mid 2020, but you don't know when, and you don't believe it till you see it, and then bam, it happens so fast. In this case, 5 weeks instead of 2.5 months. So that's stocks. So obviously we'll keep you updated on this. Now gold, which even more interesting, as I was saying at the beginning here, gold, if anything, has a reason to react to 3.45 trillion on the Fed alone and trillions more on other central banks, and this level of fiscal stimulus that we might have some inflationary blowout here down the road. Gold should have broken 1,800 easily. Physical gold is very hard to buy and has been for several months or more. Because a lot of people do see this craziness and say, well, gold's got to be it. Well, of course, we've been warning otherwise for a long time. And I've been warning around 1,800 is the best place to sell gold. So we look at two charts here real quick. We see that since the rally starting from the bottom in late 2015 at 1,050, the first top on that went sideways for about 3 months and then collapsed 19% before going into the second rally, which didn't go any higher, and then went sideways for about 3 months and dropped 19%. Well, look at this. A lot of people, normally you'd see something go up and move sideways. It's a sign it's going to break higher, but not in this case. Look what gold's done. I think the odds, and I've been saying, I don't think gold breaks 1,800. If it does, at least if it breaks like 1,820 or higher, that will be a positive sign for gold, that it could go to new highs or something. I don't think that's the likely scenario. I think we're going to find out in the next several weeks. This would say, yes, we break below about 1,670, that it's curtains, and we could go down. The most likely target would be that last low. That would be down another nice and beautiful 19%. From there, sure, we could rally. From there, I think it's much less likely that gold makes new high. So again, two critical things to watch. We are in this rebound phase. It should last at least into August by past analogies, especially the 1929 to 32 on our 90-year cycle. That's the most relevant here. And we'll see. But with the election and so much stimulus, I could see this lasting to October. So you have to decide. Today's a damn good day to sell some stocks, is what I'm saying, just in case. And if we get this next rally, somewhere between late August and late October is probably going to be the optimum. But boy, will we see that? Will we not? I think we will, but I wouldn't bet the whole farm on it. So we'll keep you updated.